Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, US shutdown fears spike credit default risk. JPMorgan warns of a tail risk event threatening global finance. So we'll discuss why a potential credit downgrade is now priced in risk and what it means for the Fed's ability to set interest rates. Second, Ozempic-style drugs create a two-tier market, sparking disinflationary fears and a potential 1% US GDP boost. We'll explore how this new class of drugs is creating a disinflationary impulse that could complicate future interest rate decisions for central banks. Third, Nigeria's OPEC for Shea gambit backfires, plunging farmgate prices 30% and raising crony capitalism red flags for investors. Today, we'll take a closer look at this shock therapy policy failure and its implications for commodity investors wary of rising governance risks. The US government is staring down a shutdown, but this isn't just political theatre. JPMorgan's trading desk is now officially warning clients of a tail risk event that could threaten the one thing underpinning the entire global financial system, the creditworthiness of the United States. A while back, we talked about how shutdown brinkmanship can morph from noise into real risk. Consider this the next step. While the stock market might seem calm on the surface, a more specialised market is showing real signs of stress. It's the market for something called credit default swaps, or CDS. Think of a CDS as an insurance policy that investors buy to protect themselves against a country defaulting on its debt. The price of that insurance, called the spread, tells you how risky the market thinks that debt is. And right now, the cost to insure against the US default is rising significantly. This is a direct signal that sophisticated investors are no longer complacent and are actively pricing in a higher risk of political dysfunction causing a financial crisis. We've noted before that investors often treated past showdowns as background noise today. The pricing says they're not. While markets have historically shrugged off these events, this time could be different. The core conflict isn't just about suspended government operations, it's about a potential credit rating crisis. Moody's has already downgraded the US from its highest possible AAA rating once before, and they issued a stark warning for the future. In a direct statement, the agency said the US rating could be downgraded again if, quote, the strength of institutions were to erode to such a degree that materially weakens the sovereign's credit profile. We previously flagged that warning. With a shutdown now looming, that trigger is back in play. The core of the problem is that a country's credit rating, especially that of the US, sets what's called the risk-free rate. This is the baseline interest rate for the entire global economy. If that rating is cut, it implies the US is riskier and the risk-free rate goes up. This has a domino effect, increasing borrowing costs for everyone, from multinational corporations to individuals seeking a mortgage. We've seen this movie before. S&P downgraded the US in 2011 and Fitch did the same in 2023, both times citing political gridlock and rising debt. Another downgrade from Moody's would confirm a worrying trend of institutional decay, but that's not the whole picture. The real turning point is the Labor Department now preparing for a total news and data blackout, meaning critical economic information could simply vanish overnight, leaving investors flying blind. As we mentioned a while back, after the 2013 shutdown, the jobs and CPI reports were delayed by about 2 weeks. And during the 2018 partial shutdown, the first read on GDP slipped by a full month. The update today is that agencies are proactively bracing for an even broader freeze. The Federal Reserve relies on this data, like the monthly inflation and jobs reports, to make its interest rate decisions. As we've discussed before, without that data, the Fed is essentially flying blind. This dramatically increases the risk of a policy mistake. They could either raise interest rates too much, choking off the economy and causing a recession, or not raise them enough, allowing inflation to get out of control. This uncertainty alone can cause major volatility in the markets as investors are forced to guess what the Fed will do next. A second credit downgrade would be a bombshell. It would likely hurt US treasuries, send yields higher, and weigh on stocks by raising borrowing costs for companies and crushing the future value of their earnings. Now, some economists are calling this another case of the never-ending fiscal follies in Washington, believing the markets have been conditioned to ignore the drama. But remember, this doesn't just hit Wall Street. We previously talked about how federal contractors typically aren't guaranteed back pay and how the spectacle itself can dent consumer confidence, especially dangerous heading into the holiday season. Each week of a shutdown has been estimated to shave about 0.2 percentage points, or roughly $6.5 billion, from real GDP growth. And in today's fractured political climate, that kind of uncertainty can also prompt businesses to slow hiring and postpone investment if a resolution isn't swift. The concern is that repeated political gridlock can erode the trust of foreign investors who are major buyers of US debt. For a Chinese-speaking audience, this is particularly relevant. China, along with Japan, is one of the largest foreign holders of US Treasury bonds. Continuing our last discussion about de-dollarization risk, if these major creditors start to feel that US political instability is a permanent feature, they may accelerate their diversification away from the US dollar and into other assets like the euro or even China's own yuan. This would weaken the dollar's special status as the world's primary reserve currency and could lead to permanently higher borrowing costs for the United States. Ultimately, the shutdown itself isn't the headline. It's the flashing red light from credit agencies and major banks signaling that this time political ineptitude could finally be the shock that erodes the foundation of the US economy. So the real indicators to watch aren't just the political negotiations in Washington, but also those credit default swap spreads and any statements from major foreign holders of US debt. Those will be the true signs of whether this is just another drama or the beginning of a genuine crisis. From a systemic threat to the global financial system, we now turn to a phenomenon that's quietly reshaping the economy from the inside out. Let's start with a couple of numbers that paint a stark picture. An estimated 1.5 million people in the UK are using new weight loss drugs like Ozempic and Wegovy, but more than 9 out of 10 are paying for it themselves. What was meant to be a great leveler in public health is rapidly becoming a wealth issue. While celebrities like Serena Williams and Whoopi Goldberg have spoken about using these injections, a two-tier system is emerging. What's happening here is not just about fairness, it's creating a clear economic divide that experts are now tracking. This is what's known as a bifurcated consumer market, where spending patterns between affluent users of these drugs and the general population are diverging sharply. For instance, recent research from Morgan Stanley found that about 63% of GLP-1 users reported spending less on dining out and 61% spent less on takeout. This is a real-time signal of economic inequality that can even influence investment strategies, prompting shifts between consumer discretionary and consumer staples, stocks. The cost for a private user runs between £100 and £350 a month. And if that was just the appetizer, the main course is just being served. Pharmaceutical giant Eli Lilly was recently expected to hike the list price of its drug, Mounjaro, by as much as 170%. So the thing is, prices are so high right now because two companies, Novo Nordisk and Eli Lilly, essentially have a duopoly with massive pricing power. But looking at the long-term view, this situation is likely temporary. There are reportedly over 160 competing drugs in development. This represents a major deflationary risk for the sector, similar to the patent cliff era for cholesterol drugs like Lipitor, but on a much larger scale. As these new drugs get approved and enter the market, competition should eventually drive prices down, which is a key focal point to watch for anyone concerned about long-term healthcare inflation. So why are people paying when these drugs are available in the National Health Service? Because access is a postcode lottery. The NHS is tightly restricting prescriptions, in some cases only to those with a BMI over 35 or 40, forcing a massive number of patients to go private. Interestingly enough, these access issues are creating global supply chain pressures and even shaping industrial policy. Different countries have different reimbursement strategies, which creates a complex web of demand. This is where the geopolitical angle comes in. We're seeing China emerge as a potential low-cost producer of these drugs, which could challenge the current dominance of US and European pharmaceutical companies. For Chinese-speaking audiences, this is significant because it could impact not only global drug prices, but also create new opportunities for China's pharmaceutical industry, potentially influencing trade dynamics in the RMB exchange rate in the long run. Even the drugs manufacturer, Novo Nordisk, admits it is concerned about the growing disparities, stating the need to pay is an option out of reach in areas of deprivation where obesity rates are significantly higher. This isn't just a health story, it's a massive economic one. Studies show patients can lose up to a fifth of their body weight, while obesity is estimated to cost the UK economy £98 billion a year. On a national scale, This is where the economic impact becomes truly significant. That £98 billion figure reflects lost productivity. Poor health leads to more sick days and lower efficiency at work. Widespread access to these drugs could be a game changer for the economy. Economists at Goldman Sachs project that if 60 million Americans were to use these new therapies, it could boost US GDP by a full 1%. A healthier workforce is a more productive workforce, which is a leading indicator of an economy's potential growth. And the economic impact doesn't stop there. It's also changing what people buy. The rise of these drugs may be creating what economists call a disinflationary impulse. By structurally reducing demand for things like food, sugary drinks, and alcohol, these drugs could put downward pressure on a key component of the Consumer Price Index, or CPI. This is a wild new variable for central banks to consider, as falling food prices could complicate their decisions on interest rates. The Tony Blair Institute has argued that offering the drugs more widely would be cheaper than dealing with the long-term consequences. But, as one provider put it, your ability to benefit from this medical breakthrough is now largely dependent on whether you have the means to pay. The bottom line is this: the most deprived areas have double the rate of obesity compared to affluent neighborhoods. And for now, the most effective treatment is becoming a luxury they can't afford. Speaking of market control, we're seeing a very different and much more troubled attempt to corner a global commodity market. A government policy in Nigeria meant to capture a bigger slice of a $6.5 billion industry has instead triggered a market collapse, pushing hundreds of thousands of women into poverty. This is happening in a country that accounts for nearly 40% of the world's entire shea crop. And, you know, this isn't just happening in Nigeria. Several neighboring countries like Burkina Faso, Mali, and Togo have also restricted exports. It's an attempt to form a kind of OPEC for shea, a cartel of producer countries trying to gain control over the global price and supply chain. In a move to boost local profits, the government abruptly banned raw shea nut exports for 6 months. The goal was to stop foreign companies from reaping the rewards and force processing to happen inside the country. Economists call this kind of abrupt policy a form of shock therapy. The crucial element here is the lack of a transition period. By comparison, neighbouring Ghana took a more phased approach to building its industry. Nigeria's sudden ban is a high-stakes test of whether this shock can force investment to appear overnight, or if it will simply cause the market to seize up. But the reality on the ground tells a devastating story. With not enough local factories to process the entire harvest, demand for the raw nuts has cratered. For the women who collect them, the impact was immediate. One worker, Hajaratu Isa, reported her daily income was cut by more than half, from 5,000 naira a day to less than 2,500. She says, "We are feeling hopeless. We cannot eat, we do not have money, and our children can no longer go to school." Hajaratu's experience is not isolated. In fact, research from on the ground confirms that farmgate prices, the price these women get for their raw nuts, have plunged by as much as 30% since the ban. This dramatic income collapse is critical because it represents the immediate social cost of the reform. It creates immense political pressure on the government, which could be forced to reverse the policy before any of its long-term goals can be achieved. This is the classic tension between a long-term industrial strategy and short-term social stability. This is where the situation takes a more complex turn. The ban came just 2 weeks after a massive new shea butter factory opened, described as Africa's largest. Its managing director admits that before the ban, his firm struggled to compete with prices from international buyers. Now, he says suppliers are calling him directly and he's benefiting from lower prices. Now, get this, for international observers and investors, this timing is a huge red flag. When a major policy change seems to perfectly benefit a specific politically connected company that just opened its doors, it's a leading indicator of what's called state capture or crony capitalism, where government policy might be shaped by private interests rather than for the public good. It signals a major governance risk and makes the entire market less predictable. A presidential advisor defends the move, calling it a bold reform to break a vicious cycle of poverty. He argues that for decades, foreign processors have reaped billions while the women remained in penury. The government's vision is to break this cycle by forcing value-added processing to happen locally. By controlling nearly 40% of the world's raw supply, the hope is to force global cosmetics and food giants to buy more expensive processed shea butter directly from Nigeria, or even invest in factories there However, the history of such commodity cartels, especially in agriculture, is filled with failures due to internal coordination problems and a lack of infrastructure. The success of this OPEC for Shea gambit is far from guaranteed. The conflict is stark. A government-mandated market shock designed to build a domestic industry overnight versus the immediate survival of its workforce. While officials aim to capture a fifth of the global market by 2030, the women at the heart of the industry are now appealing directly to President Bola Tinubu to reverse the ban. For them, the government's long-term gamble feels like a distant promise when they can no longer afford to feed their families today. Ultimately, the question is whether the government can provide some form of support to cushion the blow for the hundreds of thousands of women affected. Their survival and whether new investment materializes beyond that one politically connected factory will determine if this policy has any chance of long-term success.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.